Hello, traders. It's 8:04 a.m. Chicago time on the 11th of October, 2018. It's Thursday, the day after the 100 plus point plunge in the S&P 500. I don't know about you, but I'm coming at you from an underground bunker. I'm stocked full of diapers, tuna cans, air canisters, and several rifles because the world's coming to an end. I get that impression from the news yesterday and this morning. A lot of headlines with big red letters. Chill, everybody. It's just a small correction. There really isn't all that much damage. We're used to the slow grind up, and we're seeing something different. Volatility has increased quite a bit, but I don't see the VIX at 60. We're good to go. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Interestingly, the overall market sentiment is somewhat mixed today. Crude oil's off. It's the laggard today, trading at 72.24, down 1.27% or 93 cents. Crude's come off a fair amount, but still relatively high compared to a couple months ago. It's enjoyed a pretty good run up. The Euro stocks are off 27 points. The DAX is off 73 points. The dollar's off 33.5 cents or 0.36%. The Dow's down, the Russell's down, but only very marginally. Gold is up $20, $20, 1.68%. Money moving into gold. The bonds are up 24 ticks, and the Euro's up 425 pips, 0.37%. The 10-year note's up 12.5 ticks. So clearly, allocation is to safety. The S&P is slightly up. It's up 1.5 points, but that's basically about a quarter of a rotation right now. So that could disappear real quick. Very, very interesting trading yesterday. Volatility is not for all traders, really, but it certainly is something that I prefer, especially in a product like the S&P. Liquidity combined with volatility is a beautiful thing if you have your discipline under control. So that's basically what we've got. We got CPI this morning. CPI came in at 0.1% versus 0.2%, causing a little pop in the markets. So inflation did not meet consensus. Ex-food and energy, it was also 0.1 versus 0.2. Year on year, 2.3 versus 2.4. So, hey, maybe the Fed will stop raising rates and we can all go back to taking out the highs. And we can be happy and merry and kind of living in our own little bubble. So that's that. We also got initial claims at 214, slightly higher than expected at 207. Continuing claims, 1.66 in line. Trump, POTUS Trump was on some Fox News or something, was talking about how tariffs in China are having a huge impact and his policy is hurting China, and there's a lot more to do. He's got a lot more that he wants to do. He also made comments about the Fed. This is important because I don't really care, but the market listens. He reiterates that the Fed is getting a bit too cute. It's being too aggressive with the interest rate policies. The Fed's making a big mistake on monetary policy, and so on. So a lot of lip smacking from politicians. The OPEC monthly report came in and cut 2018 and 2019 global oil demand growth forecasts. It cut the 2018 global oil demand growth from 1.62 million barrels to 1.54 for those who are looking at crude oil. That's important. So that's where we stand as far as what's on deck for today, or what's remaining. We will get the crude oil inventories today, expecting a surplus 2.5 million barrels, a deficit of 1.8, a draw of 1.814 million in distillates, and a draw of 250,000 in gasoline. And that's pretty much it as far as what's on deck. So, so let's move on to what was expected yesterday versus what we got. Let's see what we did. So yesterday, the day before yesterday, I talked about a strong potential for reversal up, meaning the one-time framing down has come to an end. I talked about that yesterday. And we did get that, but then we opened at the lower end of the range, just below yesterday's low. And so the main bias yesterday was to the downside. So the green line, as you see here, the green being scenario one, as you see here, was looking for a drop with a potential for a push up into the point of control, as far up into the range as the point of control, 2886. But overall, I was looking for the impulse down, this arrow here, and I was targeting 2863. I was only off by 80 points in terms of the lower end target there. But and I got a comment on that. Why is it that my targets are so conservative? But I'm not. One thing I'm not able to do, admittedly, is predict the future. And so I am looking simply at where the ranges are today and predicting based on that. If it keeps running, that's great. A couple of saw two good long opportunities and a whole lot of short opportunities yesterday. Yes, there was a long in there at some key levels that pushed, I think, 12 points up or something before it started to roll over. So yes, you can make money going long on a big sell-off day, depending on the time frame. It's all about the time frame you're trading in, not the ideal trade for those who want to catch the top and the bottom, but it's just how I trade. I simply cannot predict that it'll continue going and going and going. So that's what we expected yesterday. You all know what we got. It's too big to show on the trigger chart, so I'll go to the 15-minute. And we simply fell out of the couple of days of balance that we had. We continue to move down, and we pushed a very, very wide range of 100 points yesterday, approximately, I believe, close to close, we dropped 106 to 107 points, quite a bit. Volatility increasing relatively dramatically, but not to the extent that I would think it's the end of the world or anything. I think the VIX, let's take a look. I think the VIX is up in 25 or so, 22, not too crazy. So that's what we got yesterday. Those who approach the market like I do with, the stock zones, predetermining areas to interact, you probably saw that the market just ran right through your levels, or zones like a hot knife through butter. And that's okay. It doesn't mean you should go and change your plan and go trade the way your friend does with order flow only because he made a killing and you didn't yesterday, and so on. So the biggest risk to you as an individual, as a trader today, is going to be the mental aspect. So many either got run over yesterday trying to pick a bottom. Many got run over trying to sell, believe it or not. One of the key things you have to recognize when you have action like yesterday is that you have to widen. If you're going to interact with the market, you cannot interact with the market coming in and with your 6-tick stop and a 6-tick target, or 8-tick stop and 8-tick target, when you see the level of aggression that's taking place. The rotation sizes were big right from the get-go. And I commented on this in Convergent Chat, that if there's something I can do for you today, it is to prevent you from trying to pick a bottom. And the second thing is to tell you to use very wide stops, and to compensate for the wide stops with wider targets. No sense in keeping your target at 8 ticks and increasing your stop to 12. The math doesn't add up over time. You'd need a very high win rate to overcome cost. And so, with that being said, with the market that's just very aggressively pushing lows, what's likely to happen is that day time frame levels or zones are not going to get all that much respect. So if your stuff was getting run over yesterday and we're getting frustrated because your intraday fibs or whatever you're using didn't get much respect, it doesn't mean that your method of trading the market is failing. It just means that there's a lot more emotion in the market currently than there is logic, right? So as the prices drop, there are more and more stops that are likely to be triggered, which trigger more order flow to the sell side, which trigger more stops, which trigger more systems getting out and having it's just has this cascading effect, kind of like a screaming bomb in the middle of a movie theater. The first movers kind of have a clear path, and everybody else just piles on. It just gets worse and worse to everybody else in the back. So it's kind of like that. But this is just one day, and we are going to get this kind of day at least 2 to 3 times a year. The last time we had something like this was, I believe, February 8th or so. And this is just a little house cleaning. This is kind of like, coming into your room and just pulling everything off the shelves and throwing it out in the hallway, and then restarting the foundation of the structure that everything fits together into your room again. This is what this is. It's not much more than that. It's not the .com bursting. It's not the real estate market bubble breaking or anything like that just yet. It could turn into that, but we don't see that on an underlying basis. So I just wanted to comment on that, just to kind of tell you to relax a little bit, let the market do its thing, enjoy the volatility, but you cannot enjoy the volatility by playing very, very tight on a small account with very, very tight stops and targets. Just remember that. And also, do not expect your daytime frame levels to hold. So if you generally fade the first test of the higher low of the day, you're likely to get run over on a day like this. If you look at the volume yesterday, 3.1 million contracts traded. We had 3 times the volume. We had about, I believe it was something like 6 or 8 times the range that we've been having, or the expected range and things like that. So with that being said, there's a lot that could go wrong. So that's that. So yesterday, you know the story. The overnight session, just continued lower like we would expect. The auction just got interrupted by the session coming to an end, the pit session coming to an end. And it's trying to find a base. Now, what we've been doing on the way down is we've had very large lots buying on the market moving lower, with the smaller lots dominating in terms of volume. And what that looked like to me, as I'd mentioned over the last couple of days, it looked like the market was trying to chisel out a bottom just hammering on lower prices and then bouncing up on the close, hammering some more, bouncing up lower and lower and lower, seeking out. And yesterday it just gave out. It did not successfully find those bottoms, and so a lot of that kind of gets thrown out. Now, absolutely, it is. It turns out that that's not what we were trying to do, but there's no way to predict that. I can just read what the price action is and what it's likely meaning to the current action, and it's all I can do, and that's what I'm sharing with you as honestly as I can share it. So with that being said, and we're 20 minutes in already, the S&P minis continued lower. I mean, we pushed another 53 points or so from, or not 53, 33 points or so from yesterday's low. And we have come back, and we are right here on top of yesterday's close in a double distribution profile overnight. VWAP point of control beneath us, 2767, 2768, with some bottoms at 2771. The pivot line in the overnight session is going to be right in here, 2770 to 2765. As the key area that buyers are going to want to hold if they want to see us traveling and recouping some of this this losing in value that we've had. Okay, so overall it's pretty stable overnight. However, the volume overnight is outstanding. We've had 819,000 contracts trade. It's approximately 8 times the normal volume. There's a lot that went on here, and it's important to pay attention to your overnight levels. So I'm going to be pulling this chart to the side and keeping an eye on how we are treating the key areas that we've traded. The reason I ignore the overnight during the day session once I review it is because there isn't enough volume there. Price can do what it does. If there's not much volume behind it, it kind of lacks credibility, so to speak. And so last night's not the case. There's quite a bit of volume there. Don't get, as you're trading, your job as a trader is to objectively trade. So it's probably a good idea to turn off CNBC while you're trading, and don't let that, other people's opinions and panic kind of make their way into your trading. It's important to stay as objective as possible. Looking at the bigger picture, here's what we've got on the bigger picture. What have we done? What are we trying to do? How good of a job? If we shrink this down to see, this looks a little bit messy, I know. But if we shrink this down to see what we've done, we've basically pushed the highs that we had back in February, January, and we are we've done a good job here building balance up top, and we broke down through the 2853.55 area, which was the low volume node that separates this upper distribution from the main distribution below. The most important price, the most traded price on this chart is 27.27.25, just below. That would represent the long-term equilibrium for the year, and there's some room left to get there. So is this the end of this bull market? Really, yesterday is right here. We've simply taken back what we did in July, August, and September. Not a huge deal. And we've seen this sort of day back in February. So if I scroll back to February, there it is. Here it is. February 5th, actually, is what it is. This big ass day right here, big drop. The next day it opens just on the edge, just like where we are now, and it pushes all the way back up and through. It pushes to about the 62% pullback of that day. before it makes a higher high and then it rolls over and pushes lows. That's the most similar day. This February 5th is the most similar day to what we had yesterday. So overall, it's really, and then we ended up, testing a couple hundred points down, and pushing back up. So let me turn off this profile here and just look at the price action alone. Okay, price action alone. Here's what we've got. So nothing really dramatic. This 2800 area was expected to provide some pretty substantial support. Okay, so it's this the tapping from below, push up, pull back, try to push through, pull back, push up to it, pull back, push through finally on a gap up, and then pull back to it, and then that becomes the base for continuation to 2950, or our high of 2946.50 or so. And yesterday we really just knocked on this door once before we smashed right through, because it happened towards the end of the session. So this area here was expected to be support, and it's likely to be a magnet this morning. I expect the market is likely to make its way back up to 2800, 2808 this morning on a first go. I'm running out of time. I need to get to it. So what am I expecting this morning? Definitely a continuation of at least a test lower. Sorry, there's so many levels shown here because the scale is really crunched up. We're looking at almost 200 points of prices here, and that's why you've got all these lines. But I'm going to have to keep it that way just so we can see the entire day. The overall expectation this morning is an open that immediately pushes down. I'm looking for 2770 to be tested. I'm looking for an impulse back up. I'm looking for the market to push all the way through potentially to 2807 or so before it fails back off, and then we start to resume the movement down. So I know there are going to be a lot of buyers on the long-term buyers today, potentially accumulating at these lower prices. But overall, I expect us to continue. We generally don't have, we saw something unusual in February, but we generally don't have a full pullback the next day. So that's my expectation is it's likely to seek lower, find some support lower, push up, and then ultimately drift lower into the close, into the session. Okay, so after an impulse day down, we expect a continuation. I don't know if it'll happen today or tomorrow. Tomorrow's Friday. But that's what I'm looking for. Look for the volatility to continue. Volatility doesn't just disappear overnight. It does slow down fairly quickly. But overall, the volatility is likely to continue. Secondary, we start to push up early. We get back into this 2800 area. We consolidate. We push lower. We test the low. And then we have an impulse up that brings us back into the range, and then we hold steady with this 2821 holding us from pushing any higher, giving us about 40 points of range or so. So those are the two key scenarios. The third and fourth scenarios are a continuation of the force with an open test drive lower into the overnight low and a push into lower levels. There's a lot down here that we can work towards, but 2775 being the key MC point of control and the key magnet now in this area. That's the price that has the biggest gravitational pull right now. It's the MC point of control for the entire range going back to January. So scenario 3 is likely to make us to help us work down into that area. Scenario 4 is an open test down, cannot find aggressive sellers anymore, and then it drives up and it starts to push again towards 2821 and potentially 2830, 28.30 or thereabouts. Market's about to open. Good luck today. Take care.